Welcome back to the Shortfall Show, folks. Today is Sunday, but there's always time to learn more about options, right? So here we are. And today I do have a specific agenda. I just want to talk a little bit more about these calendar spreads we were talking about recently. I use Thinkorswim. I think it's a great platform to evaluate options on and look at stuff on. And the good thing about Thinkorswim is that you don't have to have an account with TD Ameritrade to get it. You can sign up. I'm 99% sure you can get a free account with Thinkorswim without having to deposit money or anything like that. And so if you are using a different brokerage, you could always use Thinkorswim to evaluate your positions and then execute on a different platform, say Tastyworks or something like that. Anyway, so the world of brokerages is always a confusing one, and the VIX stuff has increased margin requirements usually. That due to brokerages being kind of skittish over a vol spike. Now, people are getting really skittish. They get more and more wary when the VIX gets really low. So VIX gets back down below 10. They start getting more and more wary. And actually, a little bit before that Volmageddon thing in February, a lot of these guys tightened up their margin requirements. Most notably in IB was the one who tightened up the most. People who trade VIX ETPs will know that they are notoriously hard to borrow. So if you want to short them, you have to find a brokerage that has stock available to short. It's funny how, like, when people first start trading, it can be hard to grasp the concept of shorting something and that you have to borrow stock from somebody to short. So generally, if you need to find stock to borrow to short, the best place to be is a big firm, like a huge brokerage, because that has, the bigger the firm is, the more likely they have shares to short. So somebody like Fidelity can find shares to short for you, depending on if you're sort of important enough to them. Same with TD Ameritrade. If you're the smaller of a brokerage you're at, the less likely it is that somebody in some portfolio elsewhere who's a customer of the brokerage is going to have long shares of TVIX or UVXY or something that you can borrow and short. That I'm getting off the topic though. What I meant to be talking about was the margin requirements for some of these VIX items. So there was a switch last fall to tighten these things up, and several brokerages went to like 100% secured for options, short options. So, for example, to sell an out-of-the-money call, if you sold a UVXY 20 level call, it would be the same margin requirement as if you'd shorted 100 shares. And so that can be really prohibitive. That's a big margin requirement. Now, there is definitely an argument that having big margin requirements is good, and that it forces you to keep money, enough cash on the side. And I can roll with that, but I also like the freedom to be able to take as much risk as possible. So you search out the brokerage with the least restrictive additional margin requirements, and I think that after investigating some of this stuff, I think that TD Ameritrade is better than many. They are better than IB, they're better than Schwab, and they're better than Tastyworks in that they're not 100% secure. There is additional margin requirements, but it's not as tight as 100%. So keep all that stuff in mind. Now, as far as to be able to sell naked calls, the exchange, I believe like the SIBO limit is you have to have $2,000 in account. And also, Tastyworks only requires you to have $2,000 in an account to sell a naked call. TD Ameritrade requires that you have $5,000 in an account. There's also additional hoops to jump through. For example, you have to be, there's different levels of ability of options knowledge and stuff. There's 3 tiers for TD Ameritrade, and I think for Tastyworks too, and you have to be in the 3rd tier to sell naked options. None of the strategies that I'm outlining today are advocating selling naked options though. So, but I definitely do use strategies that sell naked options. Anyway, I wanted to kind of look at the Thinkorswim platform with you and kind of go over a couple things there. So let me switch the screen over to that for a second here, because I kind of wanted to go through the process to show you sort of how I evaluate some stuff and what I'm looking at when I'm trading UVXY. And there's a bunch of different tabs. So this is the Thinkorswim application here, and I have this sort of sample account here. You can see to my, or you can't see, let me switch it over. There you go. You can see kind of behind me there is this sample position. And if you go to the top, let me see if I can make this page smaller, so because it's kind of going outside the borders here. Hold on one second. Okay, make that a little smaller. And this isn't going to be great to see no matter what, but that's a little bit better. At the top of the page here, you've got different tabs that open up stuff. So you've got like monitor, trade, analyze, scan, etc. across the top. So trade, under the trade tab, you can either go to active trader, which will give you just to buy or sell the actual stock or the underlying. And then you've got buttons along the side here on the right that will bring up different screens as well. Like here I've got a sort of a bid offer screen here. So if you go trade and then active trader, that's going to give you just the underlying. If you go trade and then all products, that's going to give you the option screens. And then in addition to that, on the bottom, you can click to open or close your position. This is not meant to be a tutorial and all this stuff. I'm just kind of going through this real quick. And then from the options screen, you can go to the middle up here and change what it's going to show in each column. And I generally like to put it, you can customize this too, and I actually have customized mine. I like to see, I have a couple different screens that I look at, but this is one custom one which I've set up that has, it's going to show position along the side, so what my position is and in different strikes. Then it's going to show this is a screen I use for active trading when the market's open. It's going to show the bid and offer size for options, so I can see what the size is, and then I have another one that I look at that is just volume and open interest, so that gives that information, so I can look at that quickly. And then I have a third one which I look at that has implied volatility and shows percents down the screen, so I can kind of see what the skew is doing and what implied vol is doing. It also, I think it has deltas. So anyways, you can set this up any way you like, but it's all useful information. So let's go for a second to the Analyze tab here. Okay, the Analyze tab is where you can kind of simulate different stuff. So for example, I can say to myself, well, what would happen if, how would my position change if I were to buy if I were to buy 25 of these calendar spreads. So let's say I wanted to buy the September July 10 calendar spread. So I would go to September here, click on the offer for the put, September 10 put. And as I do that, down here below, you've got these tabs here, price slices, and then you've got position and simulated trades. And I can, let me get myself out of the way here a second. You don't need to see me. You know what I look like. Okay, so down here, we've got price slices, which I'm kind of highlighting right here. And we've got position stuff. Now, I'm going to redo this video at some point and like blow this stuff up in post, but this is sort of the live version here. So I just clicked on buying a September 10 put. So if I go to the top of price slices here and position my mouse right at the border, I can pull the screen up, and you can see at the bottom here, it says buy one Sep 10 put. And I can, and if you go up to the price slices section, you can see how that changes my Greek. So now it's showing there's 3 price slices here for different prices. So it's 1208, 1098, and 988 are 3 different prices. And basically that's the where the ETF price is right now. 1098, it's closed, but that's where it closed. 10% higher and 10% lower. And I usually set this up so that, depending on what risk I have on, I like to set the top parameter at 85% move to the upside just to see what my risk is for a big spike. So you can manually type in 85%. And then that's going to give me, if I do it right, that's going to give me the my Greeks and how much money I make or lose for a 85% up spike. And this is showing losing $2,700 on this example portfolio. So they at the money right now. All right. So you can see down here in green, this is a, I just clicked this option to buy one Sep put. And if I go to the left here, I can click this check mark on or off, and if it's off, then it won't show up in the sample portfolio, and if it's on, it will. So you see me clicking it on and off, it changes the delta from -67 to -100 deltas. Okay. And so that's going to tell me how this trade of buying one of these will affect my Greeks. Now, I can pull this stuff back down for a second, and so we wanted to try to buy the Sep July time spread. So I bought the Sep 10 put. Then so then I can go to July here. I was looking at like July 20. Look at the 10 put July 20, and I can hold down the control key and click with the mouse to sell one of these puts. And then if I pull my stuff back up here, you can see I've got a little spread here. Actually, it's 2 individual trades, but if I'd done them right next to each other with a control, it could have been a spread there. Let's see if I can, let me try to do it again in real time to see if this will work. So, because that's generally how you do spreads, is you hold the control for the second trade. So first trade, sell that July put. Second trade, buy the Sep 10 put. Let's see if that worked out as a spread here. Okay, so then when I pull this up, that works out as a spread. So you see the spread here. It's going to fill in the prices based on the screen, and we could add like the number to that. Like, let's say if we did 25 of these spreads, what will that do to our delta, our gamma, etc.? So if I unclick this, this is the position before, short 67 deltas, short 195 gamma, collecting $29 a day. long 27 Vega. So that means for every point up in volatility, this position makes $27. Now, this could spike 30 points in volatility if there's a spike. So that's a significant number. Okay, so if I add 25 of these spreads, I can click there and I see, okay, well, my delta changes by 100, 110. My gamma gets shorter by about 200 and something, and my theta goes from 29 a day to 62 a day. So this is basically doubling my position if I were to put this trade on. And so this gives great information, and you can sample, you can try out all kinds of different trades using this analyze feature and see how they would affect your position and try out different stuff and mess around with it. Now, one of the most important features of this is if you look to the right, when it says position and simulated trades, if you go to the right, you're going to see a date there. It says 7/7. And you can change the date. And this is really great because these deltas for options are going to change over time, right? So if you're short the 10 strike, ultimately at expiration, that is going to turn into shares only at 10 and below. So if you start to move the date forward, so if we go to like 7/8, 7/9, let me see if I can move this over so it gives me the date little clicker thing. Okay, so here's this. So what I did was I just widened this out so you could only see this screen. So here's a little date clicker. So watch my deltas here. Okay, so today is the 7th, right? So shows delta short 176. But if I start to click forward on the days, you're seeing my deltas getting shorter and shorter until the front week options expire, which is on the 13th. And then the next week, then those are off the sheets, and the next week comes into play. And you see deltas getting shorter and shorter. So you want, when you're looking and modeling stuff, you don't only want to see what your delta would be today or tomorrow. You want to see what your delta is going to be a couple days from now, because you know time is moving forward. Especially like, for example, you know, now's the weekend. So when I'm trading on Friday, well, I'm going to start looking ahead of time. I'm going to maybe run my models on Monday to see what situation I'm going to be in on Monday. You know, what's my delta going to be on Monday? What is my risk going to be on Monday? Now, you want to be careful with this because as you go past an expiration week cycle, if you had front week options, as you move the date past that, it's going to assume that expiration happened at this particular price. So any sort of out of the money puts you have, it's going to assume they went out worthless. Any whatever this price is, it's going to assume that everything expired then. And that's not necessarily the case. We don't know, you know, obviously it's going to move in between expirations. So this information gets a little bit less relevant if you have front week positions coming off, and then if you start moving the date past the weeks where you have positions, big positions on, it's going to become less relevant. But you do want to see what's going to happen to your deltas moving forward. And I even find it interesting to go back in time and see what my deltas would have looked like before now. It's also going to show a you know, a sort of a possible P&L. Sometimes this stuff is not very accurate, and other times it is more accurate. But there's a thing you can click here, go back to today. So this is a great way to model stuff and check out what different things would do to your position. So that's what I do a lot of times is I'll sit here, I'll have a position, and then I'll say, well, what if I were to do this trade? What if I were to do that trade? This kind of stuff is newer to me because, you know, as a market maker, what you're doing is you're responding to order flow. So you're basically doing other people's trades. People come in, they want to do trades, you make a market, and then you do the other side of them. As a retail customer, you need to figure out what you want to do to your position, which, as a market maker, I still have ideas of what I would like my position, what I would like to happen in my position, but I have less control exactly over that, how that works. The way I control it is by changing my pricing of things. If I want to buy something, I bid it up in the model a little bit, and if I want to sell something, I lower it. But in an illiquid crowd, I can just be kind of stuck because I have to wait for orders to come in, because it would give up too much edge to actually trade. If there's like two of us trading something, then who am I going to trade with? The guy next to me? We both probably want the same thing. So depending on the liquidity, this is a new freedom for me to actually be able to decide what position I want to put on and move to putting it on, as opposed to just kind of being stuck with what I was given more as far as being a market maker, especially in illiquid options. Of course, if you're in a really liquid type of a product, then of course you can you don't give up very much edge to like turn to someone next to you and buy something or sell something to them, and so that sort of depends on the liquidity. UVXY is pretty liquid, and you can usually get stuff mid-market. I would recommend to people, if you're new to trading options, or you're first trying this out in UVXY, one huge recommendation I have is it's not necessary to go in and pay the offer, okay, or hit the bid if you want to buy something. I would try somewhat. I would think when I'm doing an options trade, I would think to myself, how aggressive do I need to be here? Is this something where the market's moving very quickly and I need to execute right now, so I need to be very aggressive? There are times when I am super aggressive because I feel like stuff's going to move really quickly. I feel like paying the offer is going to be, what's the offer now is going to be the bid in 2 seconds, so I better just jump and leap for something. But under most conditions, I would much prefer to kind of, if I'm somewhat indifferent as far as a trade goes, or I'm interested in putting a trade on, but it's not that important to me if I put it on today or tomorrow, and it seems like a good idea, like maybe I want to add that 25 more spreads, or I want to add, I want to sell a few puts, but I'm not super aggressive at it, then I'm just going to put an offer in on the offer, or put a bid in with the bid, and hang out and let it come to me. If I do want to get something done, then I'm going to put a bid or an offer in the middle of the market and try to get it for fair value. A lot of times people will trade with you in the middle of the market. There's many times is an inside market where people are looking to do something, and you might be on the other side of that, and they may be, somebody might be there sitting there saying, I want to sell these, I want to sell these, I want to sell these. Should I hit the bid? Should I hit the bid? And so if you come in with a bid that's just slightly better than the best bid, they're going to hit that right away. So there's no problem with experimenting, So like, let's say, for example, I'm just looking at this market here. SEP 9 puts are 106 bid at 121. Now that's a pretty wide market, but you see markets like that all the time. So if you're a buyer of these puts that are 106 bid at 121, get in there and test the waters. Why not, right? It only takes 2 seconds to put a 107 bid in and see what happens. Now sometimes if you see it's 106 bid at 121, you might put a 107 bid in for like a one lot, and all of a sudden everybody matches you, and all of a sudden it shows 107 bid for 300. So then you know that the market is not real that's showing on the screen. There's actually a much better bid there by many people. But if you put a 107 bid in and it just shows your one lot and that's it, then you know that you definitely are the best bid, and maybe the offer is a lot closer to you than it shows on the screen. So, experiment. If you want to buy something, start incrementally. If it's 106 bid at 121, put a 106 bid in, wait a couple seconds, put a 107 bid in, wait a couple seconds, maybe try a 108 bid, that sort of thing, because you never know, and you can save yourself money just by doing that. Being a bull in a china shop and just coming in and paying the offer, you never know if like 10 houses are actually offered at 115 when it shows at 121 hidden. And I've had it before where I panicked and paid the offer, and then 5 people offered like 2 cents below that, like 1 second later, to try to attract more bids. And I felt like a dumbass, because I'm like, well, why did I just pay the offer when there's obviously a better offer inside? So you want to massage your orders a little bit, and there's no problem trying to get mid-market. Now, there's some, as I said before, there's some like random cases where you're like panicked and you're like, I gotta get out. And sometimes it's legitimate to feel that way and to do that. And the markets are moving all over the place, and you just jump and you do that. But most of the time, that's not the case. And a lot of times lately, I've been able to, if the market's 106 at 121, I've been able to put a 125 offer in, hang out, and like an hour later, you get filled. And it turns out to be the highest trade of the day or something in that option. So, always best to try to let the market come to you, be the market maker instead of the market taker. But it depends on the situation, of course. So that's a little bit more to think about with spreads. I realized that when I was talking last time about centering a spread around, like, say, the 10 strike with UVXY right now at 11, it's if your whole position is just a time spread around the 10 strike, it's going to show deltas now that are actually not as short as they will be in a couple days. And so you want to keep that in mind. As things get real near expiration, stuff gets more and more tricky. So if you're new, it can be wise to try to avoid expiration day specifically by either closing stuff out the day before or rolling it out a little bit. If you've got short options that you're trying to collect data on, having them rolled out a little bit is helpful in that if you do get that spike, you'll have time for it to come back for you a little bit. If you've just got stuff that expires in 2 days, it might look like it's great theta decay, but if you get a move, it's not going to come back in 2 days maybe. You're just going to lose money. It'll be gone. If you've got stuff that's decaying but it's 2 weeks out, well, you got a good chance that it's going to come back over those 2 weeks if you do get a spike. So anyways, if you're like me, you're always thinking about trading, and even though it's a Sunday, you're saying to yourself, how can I make money? How can I make money? How can I make money? And I'm kind of the same way. So if you don't know about this Thinkorswim stuff, there are some great tutorials online. I think it's TheoTrade does a good one. There are definitely people out there who do a much better job than me at like very systematically explaining how to use like a Thinkorswim platform or something like that. I'm more along the lines of, I'll show you what I'm doing, and hopefully you'll understand some of it, and you can pick up some stuff from it, but I'm not the most polished person at like making it like completely 100% clear. And I'm not, when I say you'll understand some of it, I'm not saying that like, way I'm way smarter on this stuff or something. I'm just saying that this particular thing, this is the way I use it. And I'm sure that everybody who's watching is way smarter than me in some other areas of life. So don't take that for some sort of vanity or something like that. I do want to mention that I've been touting this Investor's Field Guide podcast. It's interesting stuff. Patrick O'Shaughnessy is a portfolio manager. He just took over as CEO from his father, I think, last year of this company, and he has all these they're like it's more like idea stuff than like actual like executable trade stuff, but very interesting people on, smart thinkers, and I really enjoy his podcast. Check him out at investorsfieldguide.com. Here's the music.
Hello and welcome, everyone. I'm Patrick O'Shaughnessy, and this is Invest Like the Best. This show is an open-ended exploration of markets, ideas, methods, stories, and of strategies that will help you better invest both your time and your money. You can learn.
Okay, so I'm no way affiliated with them, but I just wanted to give you the heads up. So anyways, thank you for watching today, and I hope this was a little bit helpful for you as far as these spreads. I know some of my audience has no interest in options whatsoever, and this is not going to be exciting to them at all, but that's fine. For others, I know that this is going to be helpful because they are pursuing strategies in UVXY with trading this option stuff. I did do stuff yesterday on some option stuff in Canopy Growth Corp, CGC. So, and I realized that my head was kind of blocking the screen a little bit. I'm going to try to do better with that. But my hope is that my thinking when I'm showing like a vertical spread, this is going to apply to any underlying. So my thought process with a CGC, it doesn't really matter what CGC is. It turns out it's a Canopy Growth Corp marijuana stock, but it could be anything. It could be gold. It doesn't really matter. The options theory is still going to be similar in the way that you're looking at, well, I'm betting $3 to make one, or delta of an option is going to tell you the percent chance that something is going to come to pass by a certain time. So, for example, when you look at CGC here, if I pull up this, I went to the center of my screen here, I changed the layout. Okay, so now I have the deltas of the options are the first column. So what that tells you is, for example, July options here, okay? July with CGC is trading $30 now. Well, it will be when it opens Monday, maybe. It was on Friday. How about that? When it shows that the July 40 call has a 2 delta, okay, that simply means that July 40 call has a 2% chance of finishing in the money. So options is saying that it's not very likely that this is going to 40 in the next 12 days at all. I mean, 98% chance is not. Let's put it that way. But if you go out to like October, all right, now it's a 27 delta. So in 103 days, there's a 27% chance that this will be over 40. However, if you look at the 20 put in October, there's a deltas here. There's a 10% chance that it is below or at 20 in October, on October 19th. So now it can't be both, right? It can't be both above 40 and below 20. So one of those may be true. It sounds like it's more likely that it's going to be in the middle somewhere. And that is that. So, but it can be interesting, when somebody says, oh, well, a lot of times on StockTwits, someone's going to say, oh, well, Tesla is definitely going to go to 400 by this date or something. Well, you can just pull up the options screen and be Mr. Smarty Pants and say, when someone says, oh, well, Tesla is definitely going to 400 in the next 2 weeks, you can say, well, actually, the 400 call only has a 2 delta, so that's pretty unlikely. And by December, Tesla has a 29% chance of going to 400 as the option screens are predicting. Now, options aren't always right. Obviously, 29% chance is the best guess based on the way the financial markets are trading right now. But this is interesting. Even, if you've never used options before, it's still interesting to just look and see what's the delta of a certain call. What's the chance that this is going to go somewhere? People are always talking about UVXY. Oh, it's going to 5 next week, or it's going to 100. Okay, if for the people that are always buying calls saying, well, the market's going to crash next week, well, if we look out to January, what's the chance that this is going to spike to 20 in January? Well, it has it all the way up to 45. So that seems like pretty high chance, 45, that it's going to spike to 20 by January. That seems like buying that chance sounds pretty expensive to me, because it doesn't seem that, when I think of it, I think, well, it doesn't seem that likely to me. So to me, that tells me that that's kind of an expensive option. So I probably wouldn't want to buy a Jan 20 call for $2. And, but some people obviously do. Otherwise, the market wouldn't be that. Somebody's willing to pay $1.84 for these calls. So check out deltas. Pull up a couple stocks and look at what delta it shows and think about it and say, does this sound reasonable to me? It's just a start to start checking out options and learn a little bit more about it. So that's some food for thought for you. I do have some good interviews coming up and more stuff coming up this week, and we'll look forward to the market opening tomorrow. We have a full week this week as opposed to last week, so it is exciting. Anyway, as always, I appreciate you watching, and we will see you next time. And let me cue up the music here. Do, 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 do. Bye-bye. Thanks.